Hey guys, just wanted to make a quick video talking about the importance of using data instead of emotion to evaluate what's going on for your business and your investing and everything. So, I feel like recently the stock market has been very volatile. We're seeing swings in excess of 1%. This week, we've seen multiple swings above 1% plus or minus, right, on a daily basis. And so, I looked into it and I looked at, daily returns for the S&P 500 going back about 30 years. And what I found was that, 50% of the time, so the middle 50% of daily stock market swings are between 0.5% up, 0.5% down, roughly. And, anything above that is, or below that is pretty unusual. And so I was like, okay, well, yeah, so my feeling that the stock market is swinging a lot is true. So then I looked at the VIX and stuff. It doesn't look too crazy. And I'm like, weird. So then, I basically looked at, okay, how many days a year does the stock market, go above or below 0.5% swing and on a daily basis? And honestly, we're not that far off from the historic norm. We're a little bit above it. But obviously, or not obviously, but honestly, pre that certain event that happened in 2020, that big event that caused a lot of market volatility, besides that, and before that, basically we had extremely low volatility, historically speaking. It was actually kind of crazy. So, we had extremely low interest rates and extremely low volatility before the event in 2020. So I think that's kind of important to think about, right? I would say the market feels volatile day to day when you check the chart, but when you zoom out, honestly, it's not so crazy. And I was very surprised by that because when you just look at a chart of the S&P 500 over the last, call it, year and a half, 2 years, something like that, it's gone up and down quite a bit. And I also feel like if I go back even to, and I can't exactly remember the exact years, but I feel like something like 2017, we had this period where things were kind of going up and down, kind of just going sideways, and then it just exploded up and then crashed because of the event in 2020. And then now we're going up a ton, and then it went down again, and because of bank failures, and now it's going up again. It feels very volatile when you're just sitting in the driver's seat and you're checking things day to day, but honestly, in general, it's not. At least it's not really more volatile than it has been historically, in terms of your daily swings. So I think that's just something to think about. I've had a pretty big change in my mindset in terms of, because the thing is, I think I always kind of have a little bit of a contrarian view. And so everyone's like, yeah, just put your money in the index, blah, blah, blah. And there are risks to index investing that people don't talk about and people aren't aware about. And they are actually legitimate risks in a really severe downside scenario. But by and large, it's a damn good strategy. Focusing on increasing your savings rate and just putting it in the index, dollar cost averaging over time. I kind of hate to say it. I've done a lot of work and thinking, trying to come to a different conclusion. But honestly, no matter kind of what I do, I just can't seem to find a reproducible way to beat the S&P 500 dollar cost average strategy without taking on significantly more risk. And I understand. I've done the what's called the return horizon analysis with the eggshell with the line between the risk-free rate and the efficient market frontier, that whole thing. I did that in college and that was cool, but I was always thinking well, if everyone's saying this is true, then surely there's another way to do it. And there might be people who are able to do it, but they're certainly not able to do it with less risk. without insider information. Because, like, obviously Nancy Pelosi's beating, like, the S&P by, like, 3x or something. Wonder how she's doing that. But, like, but that doesn't help the individual investor, right? Like, without that access to information, it doesn't help us. So it's kind of, like, not worth talking about. But yeah, so I guess I'm kind of waving a white flag a little bit. I'm saying, all right, Buffett, all right, Bogle, you win, a little bit. But yeah, I mean, I'm going to continue to think through it, of course. And the thing is, for me, is I just don't have that level of confidence, that level of blind belief that I think a lot of index investors have. Just just throw in a certain amount of money and just hope, just believe in the power of compound interest or whatever. Like, I understand mathematically, but I guess what I don't like is I feel like index investing, while it is quite powerful, it feels like it's out of my control. And it's kind of beyond our control, I will say, as like a society, right? Like, these companies are so big. The things that change the market are so big that, there's not even a single group of people that can really say that they're in control of it. Like, the CEOs of the major tech companies are not in control of it because the Federal Reserve sets the interest rates. And then the Federal Reserve, isn't in control of it either because it ultimately comes down to how, like, the big employers pay their, employees in order to, like, spend money in the economy. And then it's also up to, the large companies that comprise the majority of, the market in terms of market capitalization. Like, it's up to them to be efficient with the capital and to deploy it into growth initiatives. And anyway, the point is an interdependent system that's kind of beyond our control. It's kind of even beyond comprehension. It's so complex and so huge. And I think that might be fundamentally why I resist this notion that everyone should just throw money into the index, because it feels to me, honestly, like a religious action, right? Like, touch the feet of the statue and your crops will be more successful or something like that. And I understand the math. I get it. Like, I do this for a living. I understand. But it's just hard. It's hard to emotionally, I guess, buy into the math. So anyway, I'll keep thinking about it. But and also, ultimately, like, your investing strategy actually doesn't matter that much. It's crazy to think that, because you think compounding is so massive, but, like, it's actually just about how much you save as a percentage of your income. I mean, that's like the majority of your success in terms of, like, acquiring capital and keeping it. It's just about how much you can save. It's not really about how good you are at picking stocks or Bitcoin. Like, I mean, here's the thing, right? Like, if you can generate a consistent return over 20% every year with very low risk, or even medium risk, but if you're throwing darts at a dartboard to get that 20%, and, like, you're probably going to get wiped out at some point. That's the issue, right? Is, like, unless you can make 20% return per year consistently, like over a 30-year period, and not get wiped out, then if that's not you, then it's really all about savings. So, I don't know, just some thoughts here on a rainy Sunday evening at the office. Anyway, I will see you guys in the next one. Bye-bye. Like and subscribe.